When you think of accounting in a broad sense, you can think of three sets of books. Not just one set of books, but three sets of books. The financial books, the management books, and the tax books. Examples of each include the annual report, as an example of the financial books, the annual report that the company files with its shareholders each year. An example of the management books might be budget reports or product profitability reports. An example of the tax books would be the tax return that the company files each year for income tax purposes. Each of these sets of books has its own audience and its own objective. The financial books is targeted primarily towards external parties or external constituents, like investors or creditors. They're trying to decide where to put their money, so they rely on these to communicate financial information about the company. The objective then of those books is to communicate economic performance and financial position of the organization. The audience for the management books is an internal audience. It's management itself. And the objective of those books is to facilitate management decision-making in the organization. The audience for the tax books is the tax authorities, and those books have the objective of facilitating the collection of tax revenue by the government. So each of these has very different objectives, targeted to very different audiences, so we have three very different sets of books for all the right reasons. Let's talk about the rules that companies have to follow when they're preparing each of these sets of books. The financial books must be prepared in accordance with some set of accounting standards that are relatively common among a large group of firms. For example, in the U.S., companies must prepare their financial statements in accordance with U.S. GAAP, or generally accepted accounting principles. Internationally, companies may have to prepare their books in accordance with International Financial Reporting Standards, IFRS. And then some other countries continue to retain their own accounting standards, so they might have their own specific GAAP or generally accepted accounting principles. Each of those has its own authority that sets the rules and ensures that those rules are followed. The management books essentially has no rules because management is the authority there. Management pulls together the information that it needs to make good decisions. So no set of standards would be prescribed for how management might compile the information that it needs. The tax books are prepared in accordance with the tax code, and of course that is enforced by the tax authority. In the U.S., that would be the IRS or the Internal Revenue Service.